Good morning, everyone, and welcome to August. It's Ben Buckner and Dan Basse with Ag Resource Company in Chicago. The end of the week, we'll kind of break down what has happened and where we are going in the future. So far for the week, December corn is down 5 cents, wheat is down 15, and November beans down a sharper 30 cents. Weak export demand, pretty good weather. Trade deals also, the deadline for U.S. trade negotiations is come and gone. And so we've got steep tariffs on places like Switzerland, Brazil, even Canada, potentially on certain select products. And so the macro markets shedding premium, weak jobs report, revised down jobs to a cumulative 258,000 for May and June. So not a lot of bullish fodder for the market today, Dan, but if you want to kind of break down what you see and what's kind of happened and then where we're going, please.
Yeah, Ben. So we've seen the stock market really, it was getting hit overnight, and we're now seeing it even hit harder after the jobs report, down about 450 to 500 points in the Dow. I think a lot of that is relative to risk premium. And if you look at the stock market on multiples and where we've built in risk, it's really at a very, very high level. So my first point is be careful with the equity markets going forward. I think you have to be very cognizant that there may be some corrective nature to the equity markets. Now that Trump tariffs are pretty much known, I think globally, we need to think about tariff rates now 15 to 20% going forward. This is the new mantra in terms of global tariff rates. And that's a far different situation than where we've been looking backwards to the 1930s. And so a new world arrives at us today on August 1st, Ben. And I think it's pretty important to understand that and see the slowing that's going to be happening in some of the global economies as they struggle to sell additional product into the United States. Here's a graphic looking backwards. We at Ag Resource always like to start Friday out looking at rainfall over the last 7 days across the Midwest and the entirety of the United States. You can see it's been a pretty doggone wet week from eastern Kansas stretching up to the Great Lakes and then extending over to Pennsylvania. So areas like northern Indiana, Michigan, Ohio that needed rain really got it this week. Some areas like maybe northern Missouri, portions of Iowa, northwest Illinois, maybe too much rain. And so this period coming up of drier and cooler weather is absolutely welcome by crops. And the sunshine is going to be something that I think benefits crop condition ratings and overall corn and soybean yields going forward. The next graphic we want to work to here is we want to go back for the growing season to date. I believe that's from May 1st to July 31st. And so we've got one more month or maybe another 5 weeks of important growing season ahead. But you can see here when we look at rainfall totals from the 2025 growing season, those 12 weeks between May and the end of July, it's been pretty doggone good. And so there's a little bit of dryness, if you will, in that portions of, eastern Illinois stretching into Michigan. Other than that, though, we can really see some very good growing conditions. And when you think about what corn and soybean and spring wheat crops have been going through, it's generally favorable on soil moisture capabilities. And so I think this is going to really help yield potential if indeed we have a good July-August phenomena. Also, if we look at temperatures during that same time frame, notice that there's not much in terms of irregularity. Yeah, it was warm, during the month of July and the overnight hours in the eastern Corn Belt. But looking backwards even further, it's averaging out relatively well. Maybe eastern Illinois, Indiana, portions of Ohio are a little bit above normal in terms of 2 or 3 degrees being above, and that may have a little drag on corn yield in particular, but other areas are going to do quite well. So this is a crop year in which corn and soybeans will reach their genetic potential. We'll get a good handle on whether or not yields can score records as we expect. We do get FC Stone out on Monday. We've released ag resource estimates at 185.7 on corn and roughly 34 on beans. So we do believe we're in a good place in terms of yield. Thereafter, we'll see if we take them up depending upon August weather. But this kind of gives us a starting point to think about crops going forward. The other thing I want to talk a little bit about this morning as we end the month of July is where we're sitting in terms of export potential. There's been a big ramp up, if you will, of vessels waiting for Brazilian corn. Now, no one sends a vessel to Brazil unless a corn vessel or a corn has been sold. You can see here at the July 25th mark, we are now well above last year, and we're seeing levels that are close to last year's high. So a big ramp up in terms of Brazilian corn demand. I would imagine some of these sales are under the FOB markets. So if you think about where the sales have been occurring, we see FOB levels every day, but I'm being told that there was a lot of sales made on a CIF or FOB basis that were well under those levels, which is why the reason that the Brazilian vessel counts have ramped up so smartly. I believe this will have a drag on U.S. corn exports as we look forward. I think from the middle of August, looking forward to the middle of October, Brazil is going to be stealing a lot of our thunder in terms of U.S. corn and in terms of world corn demand. The other thing worth mentioning is that world wheat demand in the first month of the crop year, July, from the Big Eight is down about 2.1 to 2.2 million metric tons by our counts of vessels. And so we're not starting out the new crop wheat year very well. Although we've had some supply problems in Southeast Russia, protein problems in terms of buggy wheat in Russia, now too much rainfall in terms of the Baltics and Germany and maybe Northern Europe. We're not seeing the wheat market react other than on spreads. We've seen the KC Chicago spread rally about 20 cents this week. I think that's related to those quality spreads. But when you look at Chicago futures, we're still heading downwards. And so this is important to understand. And I think it's all related to world demand. World demand is just not doing very well in terms of world grain and world trade. To make that point even louder, I want to look backwards in terms of where shipments are from the principal exporters. And that's what I really think is so important to focus on during the crop year. When you look at soybeans, we're now, 2 months remaining in the crop year. It, of course, ends in October. You can see here we're about, 1.7 million metric tons below last year at 130.99, or let's call it 131 million metric tons. Corn exports have been 137.4 versus 146.2 last year. Wheat exports starting out the 1 month time frame, 10.4 versus 12.6. So this is why we're down about 1.5 million tons. Overall, world grain trade is not setting the world on fire. And I think this is very important as we get into the elevated tariff levels from Trump going forward, because I believe these drags will persist. This means that the job of the market will have to be to reach lower levels to revitalize or get demand forthcoming again. So when we look at price's job in terms of rebuilding demand, if you don't have world trade rising, it becomes a more difficult chore. Lastly, if you want to look at downside targets, which we always like to end up Friday on here in Ag Resource, we're still thinking about last year's low in corn. Whether it's reached in September futures or December futures is unknown, but I still think a 360 target makes a lot of sense in corn, particularly as we're seeing some very strong early yield results across the Gulf states. And again, a lot of indications in the Midwest that this is a very special and record corn crop. Also, as we look forward on soybeans, we've been in a wide trading range for the last year, really bounded by, let's say, 1075 to 1080 on the upside. On the downside, 925 to 930. I think we're going to retest that 925 to 930 as we head into the end of summer and early autumn. That seems to be a very logical target. Again, no indication that China's buying U.S. soybeans. They're not even asking for U.S. offers right now. So in my mind, that's a key ingredient why the soybean market will keep sagging if we don't have an August weather problem. So with that in mind, Ben, back to you.
Yeah, very, very good stuff. And I think, a year ago in the August report, NASA, in all their wisdom and in their, weather adjusted model, the survey, put corn yield at 183. So, given crop conditions, vegetation health, I think a number pretty sizably above that's pretty reasonable. So that report's just in 10 days at this point. So we all can kind of see and feel weather's been good. We've got a record yields developing and forecast looks good. But I think, and this is why we kind of urge people to take a trial. What we're going to be working on is, and the next concern to us is how fast can we get rid of this stuff? And you've highlighted, kind of stagnant world trade. China's not bought 1 bushel of U.S. soybeans for new crop delivery yet. Brazil exporting more corn. So I think it's the duration of maybe this new market that we're concerned about. We want to highlight in terms of risk management. So I think that's, again, $1 gets you in, we're going to provide that framework. But other than that, kind of same old. Trade deals, weather, both kind of lean negative at the end of this week. And so we're kind of going home, our tails between our legs at least. So as usual, all the best in the markets today. And we will get at you on Monday with kind of a rehash of what's going on.